Everyone, today I'm going to talk about why inflation is here, why inflation is starting to impact prices across the globe. I'm going to walk you through what this means for Bitcoin, what this means for the economy. And before we begin, I want to give a shout out to my sponsors, Ledn. Ledn is a great place to lend out your Bitcoin. Definitely recommend that you check them out. I use them personally. Okay, cool. Let's go ahead and switch over to the article. I write this first in the Held Report, my weekly newsletter. You can subscribe, check out theheldreport.com. The link will be below. So inflation is coming. Now, inflation fears have been around for a while. Inflation fears have been around for a very long time, hundreds and hundreds of years. And there's different moments in which inflation rises. Sometimes it falls. And right now we're in a moment when inflation has been low for a while, but everyone is worried that it might start to spike. And very, very recently, inflation hit a 13-year high. This was not at all expected by policymakers or economists. But to a person, an average person, they would realize that this was very intuitive. During COVID, governments printed $25 trillion. Of course, that was going to start to impact different prices. And some of these economists argue that, this is just temporary. It's due to shortages of different goods and services. No, every asset has been hit by this. And when we look at different assets like real estate has the largest gain in 15 years. Yeah, that's not just a shortage of parts. We didn't have a 10%. We didn't have a growth rate of 10% of the population. This is inflation starting to pick up in asset prices. And when we look at startup valuations are starting to skyrocket as well. Stonks, so equities, the stock market, the S&P is nearly 40% up from before COVID started. That makes no sense. The economy is not any better than it was before COVID. It's worse, objectively. It's just that there's been so much money printing. People across the world are trying to figure out, where do I store my wealth where it's going to preserve purchasing power, and the stock market's an easy one. I actually saw this today. This was so wild. The stock market has gotten so hot that AMC was 11% of the New York Stock Exchange volume yesterday. That's crazy. I mean, AMC is a dead company, and it's being traded like a huge company like Apple or Google might be, with a ton of volume. Inflation has started to pick up, and what's crazy is that the Fed actually changed their goalpost on how to measure inflation. I mean, this is wild. At first they have these goalposts of, 2% inflation is our target. And then once we start to move towards 2%, they're like, actually, we're going to change that goalpost. And what they did is they changed it to be an average inflation rate. And there's a little bit of nuance to how that impacts it. But essentially, they're moving the goalposts as we get closer to the 2% target. Larry Summers, the former U.S. Treasury Secretary, he actually weighed in on this and said, this is nuts. I mean, basically, he's saying this is nuts. He goes, we're taking a substantial risk on inflation. The sense of serenity and complacency being projected by the economic policymakers, this is something that can be easily managed. But this can all be easily managed is totally misplaced. There's no way that they can manage this. They're just pretending that everything's fine. The Fed doesn't care really about potential inflation when it's signaling to keep interest rates super low, and it's buying $120 billion of bonds per month. And Larry Summers continues to say the Fed's idea that it needs to be, the Fed thought of itself as kind of like this regulator of the cycles, where if things got too heated, it would take the punch bowl away. And if the party stopped, they would keep it going. But now, as he says, people are staggering around drunk. We are printing money. We're creating government bonds. We are going on an unprecedented money printing scale. But what's funny is that the Fed keeps insisting that inflation rates, consumer prices will fade as soon as the economy reopens. However, this could lead to a problem where if people expect the prices to rise, coupled with supply shortages, coupled with the lack of trust in fiat, then we could easily see a self-fulfilling prophecy where as expectations of prices rise, and so forth. Before we continue, I want to give a shout out again to one of my other sponsors, CryptoTag. CryptoTag is where you need to store your Bitcoin backup. This is the metal backup where you take your 12 to 24 words and etch it on metal. It's crush-proof, waterproof, fireproof. It's the best way to store it. It's what I use personally. Okay, back to the article. So some people say inflation wouldn't be that big of a deal because if costs rise, so would your salary. And that this is essentially just a unit of account number change. The problem is that inflation isn't evenly distributed. As Noah Smith recently highlighted in his newsletter, wages in the 1970s when inflation spiked didn't keep up. So workers got poorer. And basically, wages don't move as easily as prices do because companies can easily change prices, but wages are per contract and they have to be negotiated and are much trickier. Okay, so what does this mean for Bitcoin? Well, Bitcoin was launched in 2008 as an antidote to bad central banking policy. What policymakers did then was an unprecedented money printing operation that was like the craziest thing in all history, but that actually pales in comparison to what our governments just did recently, printing $25 trillion globally. This is why Bitcoin was created, to protect us against these financial elites making decisions on behalf of all of us and suffering none of the consequences when it goes south. And some of these examples, some of these charts are really, really shocking. I read this report created by Jim Reed from Deutsche Bank, and he updated these. He first compiled them in 2012 and then recompiled them in first and then refreshed them in 2017. But he hasn't done these for 2020 yet. So this is what's so crazy, is the financial situation of the whole system was in a really fragile spot before COVID, and now it's just totally shot. For example, Bank of England balance sheet as a percentage of GDP. So this is a long time. I mean, Jim Reed looked through hundreds of years of financial history, basically all recorded financial history. And when we look at like the debt to GDP ratio here of the Bank of England, it hasn't been this way for 200 years. I mean, that's nuts. And then when we look at so debt to GDP ratios are really skewed. And then when we look at like treasury bills and government bonds, the yield on them, the yield's never been lower. So it's basically saying risk has never been lower when it's at the highest it's ever been. Something is going to break there. And what's crazy about these central banks and economists or quasi-economists are that they have no idea what's actually going to happen. The smartest people in the room can't predict even the shortest term future. And this is reflected in this chart here, where essentially the market is mispricing what future expectation inflation, or like future expectations for the Fed funds rate might be. So basically the orange line is what happened and the blue line is what the priced projections were. So essentially how the bond was priced gives us an indication of how people are pricing future expectations. Essentially no one knows what the hell is going to happen. And this is of course entirely intuitive. Central banks have a data problem. There's no way they can ingest trillions of data points, make decisions on behalf of everyone in semi-real time. This is just essentially a data problem. I mean, they have to like translate they have to take every single data point of every Uber taken, every sandwich that's purchased, all these sort of things. But this is what we've created around us, this entity that is not really effective, but makes us feel good. We need something that, you know, gives us, that has authoritative sounding people to kind of satisfy this need of purpose and this need that someone knows what's going to happen. But in reality, no one does. And we want the world to make sense. You know, it's hard to infer like different causality between different data points. And we want to feel like someone somewhere is smart enough to figure out all this, but they're not. There's other issues. Like, for example, you can't run experiments like you would in the traditional sciences. Like, let's say you're in a biology or chemistry experiment. You can't with economics because let's say you can't like rerun the dot-com bubble again. There's a, you know, trillions of differences between then and now. And so this brings us to the problem of central banks, where if you can't measure it, you can't manage it. This is a product management in tech. This is a product management phrase. For example, like it's even hard to measure a kilogram. Like the preciseness of a kilogram is actually very difficult to measure. So how could we possibly measure inflation properly and then take steps to to mitigate it? So here's like a useful analogy. Essentially, central banks are driving the car, which is the economy, only using the rearview mirror, because they can't see into the future, so they're having to look into the past at historical data. How could they possibly drive the car with any accuracy? What if we had an autonomous car, a car that could drive itself? And that's ultimately what Bitcoin brings. Bitcoin has a monetary policy set in stone, and it's unchanging, and the world changes around it. It's sort of self-adjusting, if you will. So how is this all going to play out? This is the classic chart of the black line are Deutschmarks during hyperinflation in Germany. The red line is Bitcoin price plotted over a similar time duration. And so this is very representative of, and this is a log chart, by the way. So these move it to in factors of 10 on the right. So take a look at that. Same with Bitcoin on the left. So, it's likely that we're going to see Bitcoin potentially do something like this if governments and inflation really starts to pick up. Bitcoin's going to start moving with inflation as well, because Bitcoin is essentially inflation adjusted. There's only 21 million Bitcoin. No more Bitcoin will be printed, but there'll be more dollars chasing Bitcoin. So Bitcoin's value for $1 is going to go up. And when we look at what's interesting is a lot of people, I think, recently got a little bit shaken with the markets. So Bitcoin had a lot of fluctuation. So did this moment in German history. These swings, so the red line, this percentage change monthly, these are really intense swings. These are like Bitcoin-esque volatility, right? So, if you're a trader, just hodling is probably your best bet here, as if you're trying to trade these swings, the volatility is so intense. There's huge drawdown. There's even dips, as we saw that hyperinflation kick off, there's still dips though, which is wild. I mean, it's still a market where buyers and sellers will rapidly change their opinion. And ultimately, why I brought this up, we're seeing inflation start to happen. This is what Bitcoin is built for, to protect us against inflation, to protect us against money printing by the financial elite. And that's why it's all here. That's why Bitcoin is valuable. So if you're thinking through, what you should go do next, or like, hey, Bitcoin has been too volatile for me, volatility is normal. We've seen it before. Bitcoin is perfectly positioned for this moment. Hope you enjoyed. Cheers.